So, picture this. You are staring at your trading screen, and your heart is pounding just a little bit harder than usual.
Oh, we've all been there.
Right. You are holding what's called an at-the-money call option on a stock. And let's say it's trading at exactly $100 a share.
And just to clarify, by at the money, we basically mean the strike price you are betting on is exactly the same as the current share price, so $100.
Exactly. Now, it is exactly 2 days before this company releases its quarterly earnings report. And you are, like, absolutely convinced, based on all your research, that they are going to just blow expectations entirely out of the water.
You've made your bet.
Yeah, you've placed your bet that a stock is going way up, and you are ready for the big payoff.
It's a scenario that plays out thousands of times a day in the market, honestly.
Yeah.
I mean, anyone who has ever tried to trade around an earnings event knows that palpable high-stakes anticipation.
And that feeling right there is exactly why we're here today. We're doing a deep dive into a really massive stack of trading notes, options mechanics, and financial analysis guides.
Really getting into the weeds.
Yeah, to walk step by step through the decision logic of this exact trade. Basically, our mission today is to unpack a paradox. Like, why being completely 100% right about a company's success can still end up draining your brokerage account.
Which is the worst feeling in the world.
It really is. And beyond just the options math, we are also going to figure out how to look past the headline numbers. You know, how to spot a genuinely healthy company in a sea of accounting noise.
So to set the baseline for all of this, we have to establish like a fundamental rule of how markets process information.
Right.
The earnings report is basically the ultimate quarterly report card. I mean, 4 times a year, public companies have to open the books. But here's the thing. Stock prices do not react to the objective reality of those books. They react exclusively to expectations.
Which, I gotta say, feels incredibly counterintuitive when you first hear it.
Oh, totally.
Like, the actual dollars and cents a company makes matter less than what a bunch of analysts just thought they were going to make.
Yeah, because the market is essentially a forward-looking expectation machine. By the time an earnings report actually hits the wire, the current stock price has already priced in the consensus.
And that's the average of all the analyst predictions, right?
Exactly, the mathematical average. So let's say a company reports $1 billion in pure profit. In a vacuum, $1 billion is a spectacular quarter.
I'd take it.
Right. But if the market was heavily forecasting them to make, say, $1.2 billion, that stock is going to get severely punished.
Oh, wow.
Yeah. It is never about whether the performance is objectively good. It's entirely about the delta between the actual number and the assumed number.
Okay, so the hurdle isn't, did we run a good business this quarter? The hurdle is, did we run a vastly superior business than Wall Street already gave us credit for?
Yes, and that dynamic right there creates the central trap for retail traders who are trying to play earnings events.
Which brings us directly back to that $100 stock scenario from our sources. I really want to dig into the mechanics of this trap because the math is just fascinating.
Let's do it.
So you're holding the stock at $100. Earnings are in 2 days. And because of that upcoming event, buying that at-the-money call option, the right to buy the stock at $100, it costs you $8.
So you pay an $8 premium per share.
Right. And I was looking at the math in our sources, and I'm honestly stuck on the core logic here.
Okay, well, hit it.
Let's say the company reports stellar numbers. They beat the expectations. The stock immediately jumps to $105. My brain immediately says, okay, I bought a call option betting the stock would go up. It went up $5, so I made money.
Makes logical sense.
But the source material shows the trader in this scenario walking away with a $3 loss per share. Walk me through how that is mathematically possible.
Yeah, so this is where the mechanics of options completely diverge from just simply buying and holding the stock. If you had purchased the actual shares at $100, you would indeed be sitting on a $5 profit per share.
Right, plain and simple.
But you didn't buy the stock. You bought a derivative. You paid an $8 premium for the right to buy that stock at $100.
Okay.
So to simply break even on this trade at expiration, you don't just need the stock price to increase. You need it to increase enough to cover the cost of your ticket to the game, basically.
Ah, so the $8 premium is the ticket.
Exactly. Your break-even point isn't $100. It is the $100 strike price plus the $8 you paid for the contract.
So it's $108.
Your actual break-even line in the sand is $108. The stock has to move a massive 8% just for you to get back to zero.
Wow.
Yeah. So when the stock jumps to 105, I mean, it feels like a victory because you nailed the direction.
Yeah.
But the option itself only has an intrinsic value of $5.
Because that's the difference between the 100 strike and the 105 market price.
Precisely. And since you paid $8 to acquire it, you are bleeding $3 per share.
That is brutal math. I mean, you are perfectly right on the direction the company outperforms, the stock rallies, and you still lose money because it just didn't move enough.
It's a tough lesson.
Which naturally makes me wonder about the initial pricing. Like, why does that option cost $8 in the first place? That feels disproportionately expensive for a stock sitting right at the strike price.
Well, it is expensive, but it's priced that way for a very specific mathematical reason.
Okay, let me try something here to visualize it, using an analogy from the sources.
Go for it.
Think about buying hurricane insurance.
Oh, I love this one.
Yeah, so if you buy a hurricane policy in January, when the skies are clear and there isn't a single storm system in the Atlantic, the premium is incredibly cheap. The risk of an immediate payout is practically zero. But imagine trying to buy that exact same hurricane insurance policy the day before a Category 5 storm is projected to make landfall directly over your neighborhood. The price of that policy is going to just skyrocket.
It's a great analogy for the human element of risk.
Mm.
But, in the market, it's not just emotional panic. It is cold, hard math.
Okay.
Market makers, those are the large financial institutions that literally create the supply of these options. They aren't in the business of losing money.
Obviously not.
They see the earnings event coming just like you do. So they are mathematically pricing the expected size of the move into the premium itself.
So they are charging you extra because they know a massive volatile swing is highly probable.
Exactly. And in the financial world, we call this implied volatility, or FERDV. It's basically a mathematical measure of expected variance.
Okay.
In the weeks and days leading up to an earnings report, everyone knows a significant price move is imminent. They just don't know the direction.
Right. Could go up, could go down.
Exactly. So the demand for options, both calls and puts, just surges. The market makers adjust their pricing models to reflect this heightened probability of a massive swing.
So that $8 premium isn't just the stock's value.
Not at all. A massive percentage of that $8 is pure implied volatility. You are paying a premium for the sheer uncertainty of the upcoming event.
And this brings us to the phenomenon that absolutely fascinated me in the source material. What happens the morning after the earnings are released?
Well, the storm passes. The
That's right.
uncertainty is resolved.
Right. You wake up, you check your house, and whether the roof is gone or perfectly intact, the storm itself is over.
Exactly.
The threat of the unknown has vanished. So what happens to the value of that really expensive insurance policy?
It collapses. The probability of an unpredictable, catastrophic event drops back down to near zero.
And they call this the IV crush, right?
Yes. The IV crush is basically the silent killer of retail earnings trades. The morning after the report is released, all that built-up mathematical uncertainty vanishes from the pricing models almost instantly.
Because the numbers are out.
Right. The reality of the company's financials is out there for the entire market to digest. So because the unknown is now a known quantity, the implied volatility drops sharply.
Wow.
And when you plug a drastically lower volatility number into an options pricing model, the value of the contract deflates incredibly fast.
So going back to our $100 stock that moved to 105, the reason you lost money wasn't solely because it didn't hit 108.
Right.
It's because the moment that market opened at 105, the implied volatility cratered. The mathematical time value and unknown value just vanished.
Evaporated.
Yeah. The Ivy Crush completely wiped out the expensive premium you paid, leaving you holding nothing but the $5 of intrinsic value.
You really have to be right on the direction, but you also have to be completely right on the magnitude. The stock must move significantly more than the implied volatility was pricing in.
Marn. If the math is that heavily stacked against the buyer due to this Ivy Crush, how do traders ever survive this?
It's not easy.
The sources dive into a few historical case studies that show exactly what it looks like when this strategy fails spectacularly and what it requires to actually succeed.
Let's examine the extreme failure first.
Yeah, the Netflix way.
Right. The sources highlight a historic earnings event for Netflix that perfectly illustrates how dangerous implied volatility can be. Coming into this particular quarter, the consensus expectation, or our hurdle, was that Netflix would add 2 million new subscribers.
Which is a pretty high bar considering their market saturation at the time.
Exactly. But when the actual numbers dropped, they reported a loss of 200,000 subscribers.
Ouch.
Yeah, it was their first reported subscriber loss in over a decade. It was a catastrophic miss compared to the forward-looking expectations.
And the stock crashed, what, 35% practically overnight?
It did. But the underlying options market reaction is what we really need to focus on here. Netflix is historically a high-profile, highly volatile stock. The implied volatility leading into that earnings report was so extreme that the options premiums were just astronomical. Even the traders who bought puts, meaning they successfully bet the stock would crash, found their profits shockingly muted.
Wait, really? Even with a 35% drop in their favor?
Yes, because the IV crush was so severe, the pricing models had already accounted for a massive swing. So when the volatility collapsed the next morning, it wiped out so much premium that it drastically ate into their intrinsic gains.
That is wild.
It just demonstrates that when implied volatility is historically high, even being perfectly right on a massive directional move might not yield the lottery ticket payout people expect.
That is terrifying, being completely right on a 35% crash and still getting squeezed by the math.
Yeah.
But our sources contrast Netflix with a massive turnaround story where the strategy actually worked, which is Meta.
Oh, Meta. That provides the exact blueprint of what is required to beat the IV crush.
So, picture Meta after a brutal 2022. The stock had been severely beaten down, trading around $180 a share.
Sentiment was terrible.
Right, because sentiment was so poor, the baseline expectations were actually quite low. Then, management comes out and announces their famous year of efficiency.
They drastically cut costs.
Yeah. They beat the expectations on earnings per share, meaning the actual profit generated per share was higher than analysts guessed. They beat on top-line revenue. And then, as the ultimate catalyst, they announced a massive $40 billion stock buyback.
They basically delivered a perfect storm of positive fundamental catalysts.
And the stock jumped 23% overnight. In this specific case, the call options, the bets that the stock would rise, actually tripled in value. They didn't get eaten alive by the IV crush. So what separates the Meta success from the typical earnings trap?
It's the sheer magnitude. The magnitude of the directional move overwhelmed the volatility contraction.
Oh, I see.
A 23% jump on a stock trading at 180 pushes the price so far deep into the money that the intrinsic value explosion eclipses whatever premium was lost to the IV crush.
The stock blasted past the break-even point and just kept going.
Exactly.
So to beat the math, a simple good earnings report isn't enough. You really need an undeniable paradigm-shifting blowout that forces massive institutional buying the next morning.
You need a fundamental shift in the company's valuation.
Which logically bridges us to the next massive challenge in the source material.
How to spot it.
Right. If we know we need an absolute blowout to beat the options math, how do we look at an earnings report and determine if a beat is actually genuine? How do institutional investors know the numbers are high quality enough to sustain that kind of buying pressure rather than just a temporary blip?
Well, this requires moving past the headline numbers and looking at the three core financial statements. You got the income statement, the balance sheet, and the cash flow statement.
Wait, though. I mean, we've all seen the documentaries on corporate fraud.
Oh, sure.
If a company's management team knows that beating expectations is the only thing that matters to their stock price, won't they just manipulate the income statement to fake the beat? Like, how do we know the profit they are claiming is actually real?
Your skepticism is completely justified there. And honestly, it is exactly why professional analysts rarely take the income statement at face value.
Really?
Yeah. The income statement, which shows revenue and net income, is heavily subject to accounting interpretations. Management actually has significant legal leeway in how they report these figures.
Like what?
Well, they can alter depreciation schedules to make expenses look smaller. They can recognize revenue early. Net income is fundamentally an accounting concept.
So it's a number on a spreadsheet, not necessarily money in the vault.
Precisely. And that is why the ultimate lie detector test for earnings quality is comparing net income to operating cash flow.
Let's cut through the accounting jargon for a second. For a trader who usually just looks at price charts, why is operating cash flow a better lie detector than net income?
Because cash flow is exactly what it sounds like. It is the actual physical cash moving in and out of the company's bank accounts.
Okay.
You can use aggressive accounting assumptions to show a massive net income profit on paper, But if you have no actual cash coming in the door, the business is failing. It is incredibly difficult to fake cleared funds in a bank account.
So if a company reports $100 million in net income to beat analyst expectations, but their operating cash flow statement shows they only brought in $20 million in actual cash,
That is a glaring discrepancy.
it tells you the profit is an accounting mirage.
Exactly. But if their operating cash flow is, say, 120 million,
Yeah.
firmly backing up the 100 million in net income, the earnings beat is supported by actual tangible business success.
Okay, digging into the source notes, there is a specific pro tip regarding this exact type of manipulation, and it revolves around accounts receivable.
Oh yeah, accounts receivable is a crucial metric for spotting low-quality revenue.
And just to define it quickly, accounts receivable is simply money that customers owe the company for goods or services already delivered but haven't actually paid for yet.
Right. It is money billed, but uncollected.
So the sources outline a massive red flag. If a company's accounts receivable is growing significantly faster than its actual sales revenue, you need to step away from the stock.
Run away.
Yeah. Explain the mechanics of how a company uses this to artificially hit their targets.
It's a tactic often referred to as channel stuffing.
Channel stuffing.
Yeah. Imagine a company is nearing the end of the quarter, and management realizes they're going to miss Wall Street's revenue expectations.
Okay.
To close the gap, they might aggressively ship massive amounts of product to their distributors on the very last day of the quarter. They might even offer steep discounts or incredibly lenient payment terms just to convince the distributors to take the inventory.
So they ship the product, so they immediately record all those sales on the income statement.
You got it.
The revenue numbers look amazing. The headline hits the wire that they beat expectations, and the stock pops.
But, and this is the key, the distributors haven't actually paid for any of it. The cash hasn't changed hands.
Right.
So that massive revenue spike sits entirely on the balance sheet as an account receivable. If you look at the financials and see that sales grew by 5%, but accounts receivable ballooned by 30%.
That's a glaring mathematical warning that they are booking revenue today that they may never actually collect tomorrow.
Exactly. And eventually, if that cash never arrives, they have to write it off as a loss. The true state of the business is revealed, and the stock inevitably collapses.
Because the temporary pop based on phantom revenue just cannot sustain itself.
Right. The quality of the earnings dictates the longevity of the stock's reaction. Institutional money managers, they will spot that cash flow discrepancy immediately, and they will sell into the temporary rally.
Crushing the retail traders who only read the headline.
Unfortunately, yes.
So, synthesizing everything we've pulled from these trading guides, how does a trader actually navigate this minefield?
It fundamentally comes down to evaluating the mathematical setup before you ever place a trade. You must always check the expected move being priced in by the market makers versus the premium you are being asked to pay.
So if that $8 premium implies a 10% move, but your fundamental analysis suggests the company can realistically only move 4 or 5%.
You have to accept that the Ivy Crush will destroy your position even if you are right about the direction.
It's like overpaying for hurricane insurance when the radar only shows a mild thunderstorm.
Exactly. In those high volatility environments, buying options is just a low probability play.
Okay.
That is actually why many professional options traders prefer strategies like selling options before earnings.
Oh, to be the insurance company.
Yes. They collect that inflated, expensive premium up front, fully knowing that the Ivy Crush will dramatically deflate the value of the contract the next morning.
So they can just buy it back for pennies and capture the difference.
Exactly. It requires a completely different approach to risk management, but it exploits the mathematical reality of volatility rather than fighting against it.
And if you are trading the actual equity the next morning, you cannot blindly celebrate a headline beat. You have to look under the hood.
Verify the operating cash flow.
Right. Check the accounts receivable to ensure management isn't playing accounting games just to manufacture a short-term pop.
Right.
To survive earnings season, remember, you don't just trade the numbers on the page, you trade the expectations and the volatility.
That really is the golden rule.
Yeah.
And, all of this raises a rather fascinating, maybe slightly cynical question regarding corporate psychology.
Oh.
Well, given that stock moves are almost entirely driven by these forward-looking expectations,
Yeah.
and given that corporate management teams are acutely aware of how this expectation game is played, is it possible that companies routinely and intentionally issue overly pessimistic future guidance?
Like sandbagging their own numbers.
Exactly. Painting a bleak picture. not because their business is actually struggling, but simply to systematically lower Wall Street's bar, guaranteeing themselves an incredibly easy headline-grabbing beat in the subsequent quarter.